it's great to have you, as always, a day later than normal, but nonetheless, it is so good to have you for your perspective, and maybe better. You've had 24 hours now. Take it all in, right? You heard what Powell said.
Yep.
You read what they did. They cut their growth outlook. They take their inflation expectations up. And maybe most importantly, for the way the market viewed everything yesterday, they kept 2 cuts for 2025. But you've had the time now to think about it. What was your takeaway?
Well, the word of the day certainly was uncertainty. You know, he said it so many times, and you can't really blame him. I mean, obviously, April 2nd is looming. It's not very far away at all. And we have to see what happens with the tariffs. The one thing Powell said that I think the market liked a lot, I think there's no inkling of tightening. I mean, he still has 2 cuts on the dot plot, which is sort of strange and there was a lot of pushback from the reporters asking questions like, what is this about these cuts on here if you're upgrading your inflation? And it's a good question, but Powell was very much on the defensive, I thought, yesterday. But the market obviously liked the fact that there's still 2 cuts in place. And you can kind of see why. The 2-year Treasury is down a little bit under 4% now, which is quite in sync with a couple of cuts. They did downgrade growth to 1.7 real growth for this year, and they upgraded inflation, depending on what index you look at, to about 2.6, 2.7. But if you take the 1.7 and add on that inflation rate that's predicted, you're right at about 4.3, 4.4, which is sort of where the 10-year Treasury is. So he used the word, in addition to the word of uncertainty, he used the word inertia, which I thought was a really interesting word. I think he only used it once, but it's an interesting word. It kind of says that he doesn't really know. He said nobody has high confidence in their forecast right now because there's too many moving pieces on all of this. But since the Fed started cutting rates back in September, bond yields are still up. And the stock market is really doing very, very little since then. So this is an unusual time period where the Fed cutting rates by 100 basis points and talking about 2 more, we have not seen a rally in the 10-year Treasury bond. The price of the 10-year Treasury bond is down. And we have also not really had a rally in stocks since the Fed started cutting interest rates. There's that old phrase, don't fight the Fed, which is supposed to mean that if the Fed's cutting, you're supposed to stay long risk, but it sort of isn't working this time. And I think that's going to continue to be a theme as we move forward in time. I think that we have a really big problem with, and I talk about it every time we meet, Scott, with this interest expense. You know, it's over $3 billion a day in interest expense on the Treasury debt. And it's interesting that the Fed has cut back quantitative tightening down to $5 billion a month. I wonder why they didn't just go to 0, quite frankly, because $5 billion a month isn't even 2 days of interest on the debt. So you're really into the rounding category. But one of the reasons I think they did that tapering of quantitative tightening is I do think that there's a desire to have interest rates go down. And one of the ways you do that is by having less, quantitative tightening going on. So all in all, I think it's a wait and see situation for sure. And it is interesting that the Fed did give the market the idea that the tariff thing might not be an ongoing escalation problem. It might just be a one-time on the inflation rate. I thought that was a little bit surprising that he was so clearly stated on that one. And so we'll see if that happens or not, but it would seem that the inflation rate is going higher. Our inflation model agrees pretty much with the dots that the Fed has for this year of about 2.75% inflation rate. It'll be a little bit, it should be fairly calm in the next couple of months, except for the tariff effect, which nobody really knows what the answer to that's going to be. So since this cutting cycle began, not a lot of money being made out of financial assets. What's really working are the real assets. The commodities are up, gold is up a lot, and Bitcoin, which is really, right, gold above 3,000 and holding now. And Bitcoin, is just gold on leverage, really, the way I think about it. And so, of course, it's up the most since the Fed started cutting rates. So the 10-year Treasury rate is the same as it was 2.5 years ago, and the range on the low end was 3.6 and the high end was 4.8, and we're pretty much in the middle of it. So this is kind of a grinded out type of a market. The one thing that has happened, and I think that, you know, people say that bull markets climb a wall of worry. I don't feel like we have a wall of worry quite yet. I keep hearing things that are kind of explaining things away, like Fed Chair Powell said, you know, the break-even inflation rate is above 4. There's a University of Michigan, I think, survey that's shot up to 4.5 for the next 1 year inflation. And he chooses to downplay that by talking about the 5-year forward, which for most people isn't even really a thing. You know, it's the prediction of what the inflation rate will be 5 years from now for the 5 years subsequent to that. So it's an inflation rate that's way out there. I don't understand why anybody thinks they have a handle on that. But the 5-year forward has been relatively stable, while shorter-term inflation considerations have been upgraded. And so I think that we're in a very stable place. I like the word inertia. We're in the middle of the trading range. Spreads have started to widen on credit, though. That's the other thing. So if Powell chooses to talk about 5-year forward and downplay near-term inflation, and I hear a lot of people saying, well, stocks had a quick 10% drop, but credit spreads have been really well contained, well behaved. I don't really think that's an accurate characterization. It's the junk bond spread is got out by about 70, 80 basis points from what its narrow was last year, and that's not insignificant. And also the VIX, while it's come down in recent days, it's still very elevated. And if you overlay a chart of high yield spreads, the incremental yield on high yield versus treasuries, with the VIX, there's a very high correlation there for pretty common sense reasons. But the high yield spread looks on that chart that it should be widening more as we move forward in time. So I think there's a lot of downplaying of risk that's become evident in the market.
Do you think that, I mean, Powell called the move on quantitative tightening a common sense sort of thing. Do you think that was using the balance sheet as a tool more so than actual, you know, monetary policy, cutting interest rates? They still do have the tool of the balance sheet, that they can use it, they are using it, and the reason they are willing to use it now is for some of the reasons that you just mentioned, mindful of the credit markets. He talked about some tightness in money markets, but that's where he really stopped.
Yeah, I mean, the quantitative tightening is effectively zero at this point, which means we might be setting the stage for quantitative easing. I think that he let it slip a couple of press conferences ago that he wanted to get the balance sheet down so that they'd be in a position to have the potential to grow it back up again should an economic need take place for that to happen. So he's got a couple of things going on here. He's getting close to quantitative easing, and in spite of upgrading his inflation dots, he still has 2 cuts in the market. So I think he was really trying to balance everything out, understandably, because of the tremendous uncertainty. I do notice that the U.S. has stopped outperforming since the Fed started cutting interest rates. Europe is outperforming, and even emerging market stocks have started outperforming. And I think that that's sensible given this reindustrialization concept in Europe. One of the things that might be an unintended consequence of all of Trump's rhetoric is, you know, he's making people think about how much can they rely on the United States for their weapons, for their defense, for their cooperation, and that's probably going to continue to make Europe very, very bullish versus the S&P 500, which has been my concept for a couple of years now, and it didn't really work or not work, but all of a sudden, on a year-to-date basis, Europe is doing really well, and emerging markets are doing pretty well too. So I think the time is here for, I did a webcast last week called, or 2 weeks ago maybe, called Not in My Neighborhood, which was a shorthand for it's probably time to pull the trigger for real on dollar-based investors diversifying away from simply United States investing. And I think that's going to be a long-term trend.
And interesting. And it's interesting to me, too, that you really focus on the word inertia, because I wrote it down to ask you specifically about it, where the Fed chair said, and I'll quote the full sentence, there's a level of inertia where you just say, maybe I'll stay where I am. where he's talking about we need to just sit and watch because we're not exactly sure what's going to happen. My question to you, though, is there a danger that they wait too long and the economy starts to deteriorate faster and they're too late to act yet again?
Yeah, I mean, I think that's the risk. He's trying to balance this tension between their dual mandate. I mean, the inflation rate is acknowledged to be going up, so they're not making progress towards the 2%. And yet, you know, the unemployment rate, while low, it seems to be incrementally moving higher, and the deportations may have disruptive effects on the employment market as well. So he's in a difficult situation because he has to balance all of these cross currents. And I think that's why the reporters got so antagonistic. They're sort of saying, you know, you're saying on the one hand, on the other hand, you're going to need another hand for all this. And Jay Powell, I mean, I give him credit. It was a tough press conference for him, and he made it through. And I think he's calmed the markets down pretty well because this is one of the few meetings where we don't have some sort of violent reactions. In this one, it was actually pretty favorable from the stock market. Go ahead.
I'm surprised that we've gone this far into our interview and neither one of us have used the word transitory yet, like he did yesterday, which was a surprise to many people. You included?
That was a weird one. Yeah, I thought that was a bad place to go, but I think one of the reporters kind of almost meanly goading him into it. You know, he said, "Well, last time you said that." You know, last time, and Jay was obviously rattled by that because he said, well, if you meant last time that the tariffs came, he didn't want to go right to the one that was from 2021, 2022. But saying transitory on the tariffs, I mean, that's a little bit dangerous because we don't even know what the tariffs look like. But he's trying to thread the needle, and I thought he did just about as well as he could, and the term inertia, I think, reinforces that. He's basically saying no move's better than a bad move. I think they're going to be their philosophy for the next meeting as well. I don't believe we're going to see a cut at the next meeting.
When do you think we get the first one?
I think it might be in June, July type of time frame is when the first cut will come.
You know, it's interesting as they try and gauge and game out how the whole tariff issue is going to work and whether, in fact, inflation caused by tariffs, if at all, is transitory. I'd love your reaction to what the former Fed Governor Kevin Warsh said in his op-ed. It was back in January, but it's poignant now, where he essentially made the case that it's up to the Fed itself to make sure that tariff inflation is transitory. Quote, it's the Fed's duty, designated by Congress, to ensure that changes in relative prices don't become embedded in the economy. The Fed's job is to stop second-order effects of price changes. I'm wondering if you agree and if you think they can actually do it.
I think Jay Powell sort of parroted that yesterday as well. Whether they can do it or not is a real unknown. I mean, this is a very difficult situation. You've got an interest rate, and you're supposed to be dealing with geopolitical cross currents. You're supposed to be dealing with tariffs. You're supposed to be dealing with an inflation rate that is not cooperating. And all you got is this one number. And then you've got your quantitative easing or quantitative tightening. I don't know. I feel like the second order effects, if you will, I really don't know the answer to that question, where they can pull that off or not. And I think we're just going to have to use that inertia concept again and see what path this goes down and what responses we have both fiscally and monetarily and balance sheet from the Fed. So I think this is why we're stuck in this range where we are living in the middle of the interest rate ranges. We've been very constant on the 2-year Treasury being the guidepost for the Fed, and they're still in sync with it, talking about 2 cuts this year. So I believe that investors should have already upgraded their portfolios. We certainly have at DoubleLine. We've been upgrading all of our funds. In the funds where we have leverage, we've been decreasing the leverage with the lowest leverage in our leverage funds of all time since the founding of DoubleLine, 16 years ago. And so I think there's the rally that's happening with high yield being a little bit better in the last 2 days, stocks being a little bit better, I think that we're going to have another bout of risk. And I think that you don't have high yield spreads widen by just 70 or 80 basis points and then just stop there. I think it's going to widen out. The utilities are outperforming, and when utilities outperform, that usually means that treasuries outperform high yield bonds. And that's been happening for sure. And I think that this is the early innings of the purpose of a higher quality portfolio in fixed income. I still don't like the long end either. I'm not a fan of 30-year treasuries. I still like shorter maturity bonds, 2 years, 5 years. It's really the same playbook we've outlined, except in past visits, Judge, except this time I think you should be doing it more aggressively because it's already begun. I think the de-risking of bonds is going to start happening at a greater velocity. And so we want to have, and we do have, lots of dry powder for buying things when they're truly cheap, because we're not truly cheap in anything right now. Yes, but things are better. The PE's not as bad as it was, but it's still not in a buy zone from a value perspective. And I would say the same for the periphery of the credit market. So we're still playing wait, and ready, aim, but we're not pulling the trigger.
Yeah, well, you like a lot of people, because there is such a degree of uncertainty that it's hard to have definitive moves in the market because you just don't know what tariff policy is going to be. You don't know to what degree the economy is going to continue to weaken as well. And I want to ask you about that. On the chance of a recession, the chair said, well, there's always a 1 in 4 chance. Quote, it's moved up, but it's not high. You've had the Treasury Secretary on this very network talk about a detox that is needed. You have had an administration that really has not gone out of its way to talk people off of the idea of a recession. I think in some cases you can make the argument that they have almost telegraphed that you could have one. And if you do, we'll be better in the long run anyway. Your thoughts on all that?
Well, the change in government spending, I hope, is going to be to less government spending. Certainly that is the purported idea of this DOGE situation. And lower government spending is going to lower the pace of economic growth. I mean, we've been living on, $2.2 trillion is the actual budget deficit for the last 12 months, $2.2 trillion. And if you're going to get that down to any sort of sensible number, it's going to knock a lot out of GDP. The one thing I think that is really bizarre is people that say that we're going to get growth up to like 3% real or something like this, or even 4%, 5% nominal, and at the same time we're going to balance the budget deficit. Balancing the budget deficit is not going to help increase growth. That's what the detox is all about. You've got a problem, you know you have a problem, you've got to start solving the problem, and I've been in favor of this for a long time. I think cutting 100, it's kind of disheartening that cutting $100 lousy billion potentially out of the government budget is being met with hysteria, as if that's even a drop in the bucket. I mean, it's nothing. So we need to cut a lot more than that if we're going to get to a true detox. So I don't know if that can happen, because I think the cutting will weaken economic growth, which may lead to a counter response. It's one of the problems when you get yourself in one of these vicious circles that we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow, higher than 50% for a recession.
Yeah, I think it's 50 to 60 is where I am. Yeah, and I don't think you're going to get a rally out of the long end of the Treasury bond market. I think that already happened. We had that Pavlovian response, and we had the 10-year down to 360, and now we're back up at about 4 1/4, and I'm not sure we're going to go below 4 again, in spite of the fact the economy may weaken.
How much of a risk is stagflation? I read one person's comment today within one news article saying that we already have a, quote, whiff of it, but it's with a small s, not a large s. Is it a real risk?
I think it is. It's certainly non-zero. I mean, the tariffs could very well be inflationary, and the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP, so we're getting closer to recession, and they just upgraded the inflation forecast, although just for this year. I do think it's kind of wishful thinking to think that somehow magically it's going to go back down to 2% in 2027. But I think that forecast is mostly hope that that's going to happen. We don't see, I mean, with the Fed saying they're going to cut interest rates and tariffs coming on, I have a hard time seeing how the inflation rate is going to settle in at 2%.
I want to get your take, too. You had to figure this was really just a matter of when, not if, that the president was going to weigh in, of course, related to the Fed and interest rates, in which the president posted last night, quote, and we'll show it and I'll get your reaction to it, the Fed would be much better cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. What's your reaction to that?
It's kind of par for the course, you know. That's kind of the type of stuff that he does relative to the Fed. But I think he's not going to make any progress with that because the word is inertia. We're not in a period of flux. I don't think he's going to be jawboned into changing his interest rates. Jay Powell should wait and see. He's going to wait and see. And so I'm glad you wrote down that word inertia because that struck me as well. And I really think that defines what the posture of the Fed is for the few months ahead.
I also thought that the op-ed from the editorial board in the Journal today was quite interesting, where they made the argument now that tariffs, quote, give the Fed an inflation foil, that Chair Powell and company can basically pin any spike in inflation from here forward on the president, not themselves, that it gives them, quote, convenient cover. Do you agree?
I don't see how you could disagree with that. I think that's right. I mean, if inflation goes up, in April, May, then it's pretty easy to say that it's tariffs. And of course, Jay Powell said pretty clearly that he thinks the reason that inflation expectations have gone up by the consumer is tariffs. I don't know how he knows that. It's certainly a candidate for the reasoning why these surveys for inflation have gone higher and the break-even has gone higher. But I don't know. I think people still are just distressed about the price level. We've talked about this before. The prices went up so much over a 3-year time period. And yeah, eggs are down a little bit, and gas is down, oil's down a little bit, but the price level is still very, very high. And I think that's really what's hurting. That's one of the reasons for my view on the consumer and the economy. I think the consumer is still grappling and perhaps is running out of wherewithal to grapple with prices of necessities. And it seems like inflation never really goes down. The price level never really goes down. The inflation rate can go down, but the price level doesn't. And we're going to be lingering with that. And that's putting downward pressure on the consumer's wherewithal.
Do you have more worry on that note than the Fed chair seems to have, at least at this very moment? I mean, he's made the case multiple times here that it's dangerous to read into surveys too much because survey doesn't often end in reality. A consumer that answers questions that they're more concerned doesn't necessarily mean that same consumer is not going to go spend.
Yeah, there's that lack of the wall of worry again. You know, Jay Powell did say the hard data is solid, it's the soft data. Well, you know, it always happens that way. That's why I look at these consumer confidence surveys and the like, and they're not terribly encouraging. So first spreads on high yield widened by 10, then they widened by 30, then now they're out by 70, and the next thing you know, they're out by 150. And the soft data turns into the hard data. So I don't like dismissing, and Jay Powell's pretty good at following this too, although I don't think he did it that well yesterday. You know, you don't want to throw out the data that you don't like just because you want to focus on a narrative that you want to, is favorable for your messaging. So I don't take those are leading indicators. So I don't dismiss them.
Let me lastly ask you before we go. I think a lot of people, I know a lot of people came into this year with high hopes for this market. New administration, talk of relaxing regulations, tax cuts, and all of these pro-economy and market agenda items. I'm wondering what you make of the markets since Inauguration Day, where almost everything has been down. Are you surprised?
Well,
what's your view?
No, I'm not surprised. There's an old phrase that's worth heeding: buy the rumor, sell the news. And in the aftermath of the election victory in November, everything went strongly up, and it's quite common for once it gets started, then you start to realize that we've already priced in the good stuff. Entering this year, we had the highest record for investors' ideas on how well stocks would do in the next 12 months. It was like the highest ever, which is always a bad sign. And so there was a lot of optimism built in, but that was because the market rallied in anticipation of all of this happening. And now you have to get on the other side. We said back at the last Fed meeting, I said I have no interest in these momentum names. I want equal weighted instead of market cap weighted. And obviously that was a very extended trade. It reminded me of the late 1990s. I don't think this is over. I think this is the first move, and I think we're going to see risk get cheaper, and you want to have dry powder so that you're in a position to take advantage of it at that time. That's my primary recommendation. We've already done that in a significant way over a significant period of time here at DoubleLine.
That's a good place to leave it. And this will be continued, of course. May 7th, you have April off, but I'll see you on May the 7th.
Yeah, well, I think we're doing it live. I'm going to be at the New York Stock Exchange, I think.
We are.
Maybe we can do it there.
We are. You'll be sitting right next to me here at Post 9, and I can't wait for that. Jeffrey, be well. Thanks as always.